2023 has been a challenging year with negative corporate earnings revision and a weak Malaysian ringgit. The rebound in China has been underwhelming and is further pushed out into 2024. Going forward, we expect 2024 to be a year of multiple transitions. If inflation continues its current downtrend, central banks may not see the need to raise interest rates again. In fact, if the full effect of higher interest rates kicks in and puts a strain on developed economies, central banks may transition to cutting rates to prevent the major economies from going into recession. For Malaysia, we should expect to see continued growth in the new year. The Ministry of Finance forecasts our GDP to grow 4 to 5% in 2024, underpinned by private and public investments and recovery in the external sector. Headline inflation is expected to range between 2.1 to 3.6%, making room for upward adjustments as fuel subsidy transitions to a targeted model in second half 2024. That said, Bank Negara is likely to hold interest rates steady at 3% throughout 2024. We expect corporate earnings in Malaysia to grow at high single digits next year. This will be mainly driven by the structural reforms based on the recently announced new Industrial Master Plan, the National Energy Transition Roadmap, the Johor Bahru Singapore Special Economic Zone, high construction activity, and stable commodity prices. We also expect the technology cycle to bottom out and rebound in 2024 to provide some tailwind to the local market. The underlying strength in employment should provide support for domestic spending. Meanwhile, further recovery in tourism activities is expected. All these should be supported by political stability under the unity government, which should allow for clearer focus on policy execution. In a slower growth environment, we maintain our quality bias as we focus on companies with resilient earnings and reasonable dividend yields to anchor portfolio returns. We look forward to opportunities in key domestic themes on energy transition, the JB Singapore Special Economic Zone, infrastructure pump priming activities, and technology or E&E investments, which continue to benefit from supply chain transitions. Rising geopolitical conflicts and supply risks could see commodity prices trading at higher levels. Plantation names did poorly in 2023, but earnings may improve with higher CPO prices expected in 2024. Consumption may be slower, but selective companies with strong branding and pricing power may still benefit in the current environment. Malaysian banks are quite resilient, as loans will likely grow in tandem with GDP growth. Thus, we do not see much downside risk in net interest margin or credit cost, and continue to like selective large banks, which enjoy decent ROEs and offer high dividend yields. As economies continue their transition to a net zero future, investors are increasingly applying a just transition lens onto climate action. As we seize the opportunities arising from the multiple transitions, we are mindful of the potential risk and the lessons learned in 2023. Market volatility is here to stay as policymakers prioritize credibility over market pressures. Now, some potential surprises in 2024 could come from stronger than expected US growth. If there is no recession and the Fed manages to engineer a soft landing, this will boost markets. Perhaps a re-acceleration of inflation if the current downtrend is broken and inflation suddenly picks up again. Locally, this could be spurred by the rollout of subsidy rationalization and progressive wages, in addition to potentially higher commodity prices and food costs from climate change. Underpriced refinancing risks, potentially stretching corporate balance sheets. And it goes without saying that an escalation of ongoing wars or introduction of new wars is bad for the market. Weaker than expected China, that may continue to contribute to further disinflationary pressures in the region. And 2024 is also a year of elections for a few countries such as Taiwan, Indonesia, India, and the US. Therefore, investors will need to be nimble in their views and positioning. Diversification and risk management remain key to portfolio resilience when underlying market drivers are changing so swiftly.